So let's go through this.
I have a correlation directly to what I shoot on there.
All right. So you guys are getting the videos? Videos, okay, good. And then any like quick and dirty foreign stock market updates or news, Dow, oil, gold, currency, there's a lot going on. Major stuff going on. What? Job report?
Came out today.
What's the number?
3.8.
What's the, how many did they, how many, what was it? Nope. Nope. Yeah, it was like 28 or something like that. It was like 3 something. There was a lot that went on. The Groggy, who is basically the central bank guy from the European Central, excuse me, I can't talk over people. The European Central Bank basically came out with extremely dire projection for the European economy. Over accommodation, QE again looks like it's coming, lower interest rates, probably coordinated global central bank policy will probably QE, we'll probably see QE again. I don't know how big these guys can like blow up their balance sheets again, but you'd think they would be at a limit, but there's no other choice but to print more money and start buying corporate and, treasury, you know, or sovereign bonds to try to inject liquidity into the system. So it's happening in China, it's happening in Europe, it's happening in the United States. So it'll be interesting to see if monetary policy is effective. And if there's going to be coordinated fiscal and monetary policy this time around. So it's coming. Okay. It's already in the works. Where's oil? You guys should be on your computer looking for the information.
Crude oil is at 55, 53.
Okay, up or down?
Down 1.13.
Any reason? Okay, give me gold. Gold per ounce. This is a trading simulation, a trading lab. You work in a trading environment. You're working for on the trading floor for JP Morgan. This is an early morning briefing. We're going through the markets. Yes.
Gold up 1%.
To what?
$1,299.
Okay. And if gold is up, what does that tell you about geopolitical risk and inflation expectations? Up or down?
Risk is going up.
Up. Got it. And then what about that 10-year treasury yields? And I'd even take the German Bund 10-year, and I'd take the Japanese 10-year too. Where is the Japanese and the German 10-year yield compared to the United States? You should know this off the top of your head. Is the U.S. 10-year treasury yield positive or negative?
Flat.
Where's it yielding? Where's it yielding? The 10-year treasury yield. Where's it yielding right now? What is it yielding? Yahoo Finance. What is it? 2.6. Where's the German 10-year and the Japanese 10-year? Is it positive or negative?
German's much below. It's still positive, but
It's almost zero.
it's almost zero.
Yeah, and then I think Japan might have, it's floating between, yeah, zero and negative, exactly. And then where's the US dollar to the pound and the euro? Especially the pound. This is like a big deal. What's going on in London right now? Brexit, okay. And Theresa May is basically saying, if you guys don't vote for it, I'm out. Okay, if you don't vote for my thing, I'm out. I'm going to dissolve the government, and I'm going to call for general elections and another referendum on Brexit. The big issue is between Ireland, and Northern Ireland, and the UK, okay, because they went to war basically in the 80s, and they basically brokered a peace. So they want basically the Northern Ireland wants to stay in the EU, and the UK wants to leave. So it's a violation of their peace agreement that they signed basically 30 years ago. Okay, so that's a big deal. So we already went through all the statistical pre-test. I looked through it. There was no technical analysis in there, so I might have to go over that with you, or you can look at your notes. Your global stock memo should be done by now if you haven't showed it to me and you handed it to me and it looks all messed up. You know, I'm gonna probably get a little upset. So you're gonna have to use that time next week to basically pull all this stuff together. The global stock passive portfolio, you're gonna be working on that next week too, along with the in-class exam. Okay, so you gotta get the data in there, you gotta let me audit the spreadsheet so that it's all correct, it's calculating correctly. Once I sign off on it, you can do the memo, you can do the, put the spreadsheets together like you did before, and then put together the PowerPoint presentation to do the presentation. You should have already set up your CME account, and I'll go over that later. The in-class problems, you guys did a great job on that on Wednesday. That was awesome. The homework problems, I don't know, did you guys finish that? Can you hold it up and show me that you finished the homework problems? I think that they were due today, if you read the syllabus. If you got them, show them to me. There should be a cover page, or you should have at least started on it. If you didn't start on it, it's not that hard. There's not that many problems, and the solutions are already posted to the website.
Are the questions posted and
The problems are listed in the syllabus, and then the solutions are posted to the website.
Because I was thinking the solution for just the questions, not the problems.
No, that's the problems. That's the in-class problems. That's not the homework problems. So there's in-class problems where I gave you the solutions, and you had to look up the question. The homework problems, I gave you the question, you gotta look at the answers. Okay, can you follow? Okay. Global stock market fact sheets. Did everybody get one of those? Global stock market fact sheets? You know what I need one emerging market and I need one established
Oh,
market.
yeah, we went over that in class last.
Got it, yeah.
Wednesday.
Yep, Katie went over that.
Yeah.
The global country iShares ETF fact sheet, you may want to go up onto iShares and pick Germany or Japan or Eastern Europe or whatever. Go find an ETF portfolio that, I would do it by country personally, because for the midterm section, what you're going to do is you're going to print out 5 of those iShare fact sheets by country, and you're going to put together a country fund. Okay, so I want you to just go up there, print off like a German fund ETF, and just print it out so that, and then you're going to put that in the deliverable. Okay, so I'm starting to kind of overlap into the midterm area. Peer-reviewed journal article, you only need to do one of them. And actually, there's some posted onto the course website. There's like a ton of them. Here's the worksheet. It shouldn't take you more than like a half hour to do this. Just read the article and then fill out the worksheet. Okay, and then you're going to need to do 3 of these. Okay. I'm sorry, you're going to have to do 3 of these. Okay, for our contract. Everybody's going to do 3 anyway, but you're probably going to have to do 5 of them. Okay.
No problem.
Yeah, and then you're going to roll it up into a paper. Okay, so pick a topic, and if you want to work with me on a topic, we can work on a topic. And then we can go find the research and then write up a mini research paper.
Sounds good.
Yes.
Is it 3 due next week or 3
No,
over the
just one.
semester?
Just do one. I'm just testing you. You know, just to do one. I'll go through the deliverable package. Okay. And then the quiz, I reviewed that. I'll probably review it again just to go over it. It's basically the pre-test. But again, the critical component to the quiz is you want to print out the 3 currency pages from, you can use stock charts or big charts or some chart. You got to do a 3-year chart and then conduct a technical analysis. And then you're going to have to draw out the yield curve for the US, Japan, and Germany. Currently, 1 year ago and 5 years ago, so you can see the dynamic changes in the yield curve, and then calculate the spreads for the different maturities against the US. So you can see that the US yield curve is significantly higher than Japan and Germany. That's why the US is sucking in all that foreign currency. That's why the foreign currencies are being depreciating, and the US dollar has appreciated significantly over the last 10 years and stayed relatively high, even though we have a negative balance of payments, is because we offer higher interest rates compared to anybody else in the world, okay, for an industrialized, advanced economy. And that just sucks in dollars from all over the world, which props up the dollar and puts downward pressure on foreign currency. And then a resume. I think I left the example of the business cards. I can bring some example business cards. How many people have business cards? That's awesome. Why don't the rest of you have business cards? You go to Stanford, you go to Berkeley, you go to Columbia, you go to MIT, you go to Georgetown, you go to UCLA. The undergrads all have business cards. Everybody has business cards. Why would you have business cards as an undergrad? Why would you have a business card?
Put
Why would you
yourself
have a
out on the
business
job
card?
market.
What?
Put yourself out on the job market.
Yeah, because you're constantly interviewing. If you're gonna get somebody's business card, they're gonna expect a business card from you. When you give somebody something like a business card, you now have them. They basically owe you something. When you give something to somebody, they feel obligated to you. If you don't give them anything, they don't feel any obligation. It's psychological. So if you can trade business cards, you basically created a relationship. When you don't give them anything, you don't have a relationship, okay? It's all about trust and relationship. So business cards are extremely important, and I'll bring some examples. Okay, let's do an audit. Team 1, did you do chapter 1?
Yeah.
Okay, got it. Team 2, got it. Team 3, got it. Team 4,
Chapter 40.
got it. Awesome. Team 5, Team 5? Did you do Team 5, chapter 5?
Yeah.
Awesome. Team 6,
Yes.
got it. Team 7,
We're ready to present.
perfect. Team 8, got it. Team 9, okay. All right. And then, let's keep going. Isn't this fun? Aren't my classes fun? It's just like,
Yes,
it's like going out for a beer after, work or something. All right, so the class schedule next week, Monday, Wednesday, Friday, 11, 13, 15, you're gonna come in and you're basically gonna build your deliverable packages and you're gonna be working on your class exam. If you have any problems, just ask me questions, okay, and I'll help guide you and help you put the package together, okay? I've been accused of making busy work for people. Maybe that's what I do for a living. But it's really putting together these professional packages that I think are really good. It exposes you to a lot of different information, a lot of professional product, and you know how to start putting packages together because that's what you're going to be doing in the real world. So the deliverable 1, I'm going to push out to Monday, March 18th. So you'll have the weekend to do it. So you got this weekend, all next week, and then you got the next weekend too. Okay, so hopefully that'll give you some time. If you still have problems and you still need more time, just work with me, okay? Communicate with me, because I can't read your mind, and I'll work with you to help you out, okay? Apple doesn't make an iPhone that reads minds yet. Maybe they'll come up with that. That'll be the next killer app. And then the global portfolio presentation, your passive portfolio presentation will be on Friday, March 22nd, because I got Steve, what was his name again? Parlett.
He's coming up?
He's coming on the 20th,
Oh,
Wednesday the
cool.
20th. This guy basically ran like, what was it, like Citadel, didn't he run like billions and billions? $3 billion portfolio, both global and domestic. So he told me, I was telling him what we were doing in our class, building all these spreadsheets and doing portfolio construction and all that stuff. And I said, did you ever do any of that stuff? Can you bring some technology in to like show us on the Excel or, some other advanced stuff? He goes, oh, I never did any of that stuff. I had analysts do all my work for me. And I said, great, because, my students would be perfect to come work for, Citadel or anybody in your network because they know how to work in Excel and they do, they know how to do hard work. So, and actually I did get a line on a position. If anybody's interested, I got a line on a position, an internship that's paid at one of these private equity firms as a portfolio assistant. So if you're up to it, you need to work with me, and then if you can convince me that you're the person for this job, then I will advocate for you, and I will put you in the front running for the position. Okay, great opportunity. Okay, so what does the deliverable look like? Okay, it's got a cover page with a big black bold clip, on it. Joey, do you remember that? Do I still have yours from last semester?
No, I had it. I actually showed a person I was interviewing with the delivery.
You did?
And she was really impressed.
Yeah, that's awesome. Perfect. That's exactly what we're for. And then you have your global stock memo, okay, after the cover page. Then you have your global stock market fact sheet. And then you have your peer review journal article worksheet. Make sure you staple the article to the worksheet. Okay, and if you need any help on the worksheet, let me know. okay? Because we'll probably do maybe 2 or 3 more of those, because you're gonna write up like a mini paper. So pick a peer-reviewed journal article from an established academic journal, either on currency or global portfolio or global capital, capital budgeting, whatever interests you on the global side, pick an article, read it, and start getting used to reading these academic articles. Okay? And the worksheet walks you through exactly how to analyze these articles and what to pull from them. Okay? And then the homework 1, have the homework 1 and with the cover page, and then staple the in-class problems that you've signed and dated, clip those all together, so that's your problem worksheet, okay? And then the in-class quiz, the statistical pre-test, the global passive portfolio report, and again, you can hand that in on that Friday, but I would like to, next week, I'd like to look at the spreadsheets, make sure they're calculating correctly, make sure you're calculating the alphas and the betas correctly. There should be a cover memo to that if you need the template. I can give it to you. If you have the investments class, you have the template, share the template for that. And then you have the Excel spreadsheets. That'll be after the memo. And then I would staple those together and then staple the PowerPoint presentation, 3 per page with the note lines, staple that together and then clip it together as a separate little mini deliverable. Okay, does that make sense?
Sorry, say that one more time.
Yeah, so the Global Passive Portfolio Report is gonna have the cover memo, and then you're gonna staple the Excel spreadsheets to the memo. And then you're gonna print out the PowerPoint presentation, 3 per page with the notes in it, staple that together, and then clip it all together as one like little mini portfolio report. And then print out your team chapter PowerPoints, again, 3 slides per page with the notes, and staple that together so that I know that you did that. And that's the way we print it out. When we, there's 2 ways of printing it out. Usually, before you go to production, when you're making a presentation in front of somebody, you're gonna do the 3 slides per page with the notes so that they can take notes as you're doing the draft presentation, and they're gonna give you that back with the notes on it so that you can fix the presentation. And then what you're gonna do after that for the formal presentation is you're gonna print it out 1 slide per page with the plastic cover, the black wiring with the black back, and that's gonna be the deck that you present at the final presentation on whatever you're doing. And most of you have already been through that. And then print out the global country iShares ETF fact sheet, because you're gonna use that. Print out a bunch of those for the midterm section, and then give me a resume and/or a business card. If you give me a business card, staple the business card to the upper left corner of the resume. Okay, and that's kind of the deliverable. That's perfect. Yep. So that's there might be 2 pages to that.
Yeah,
there's 1 page. Is there 2 page? There's 2. Yeah. Then just staple that together. So you already have it. So this is what the iShares, did I already hand this out?
Well, that's what you handed, but that's an example.
Yeah, this is an example of the iShares worksheet. So if you go up to the website, in the right-hand corner, there's a PDF link that's that you click on, and you just print that and then staple it together. I just want to make sure that you know what these things look like. And we'll be using iShares probably for the fund-to-funds portfolios that we're building for the equity, public equity, and the bond portfolios that we're going to do later. Okay. All right. Any questions? Yeah. Okay. She's been through it. Everyone's been through it. You guys have been through it. You guys have been through it. So the people who haven't been through it, we should be working with them, and helping you. Yeah. And once you've been through it once, it gets easier, right, Eleanor? Eleanor loves to put these together. Okay, so you guys are ready to go, so we're ready, we're looking forward to it. touch base, are you gonna see Nicole?
She's in Disneyland right now.
And then are you gonna see Billy? Are you
I see her all the time.
gonna see Billy? See in any of your classes? Is Billy in any of your classes?
Billy Martin?
Billy.
Oh, no.
Are you gonna see your, are you gonna see any of those guys?
Yeah.
Are you?
Not today, but.
On Monday?
I've never.
Yeah, I appreciate it.
No. It was what we were talking about on Wednesday. That page was showing us the top four companies in like she did Australia, so I feel like I'm pretty sure.
Yeah, there's a lot of gold.
Okay, I'll show you.
No, because I don't want to do
No, but then are emerging, or if it's both emerging, or it doesn't matter. And I don't remember. I don't think she ever said that. Yeah, me too. Me too. But I guess she wants to know. So they look like this. See, this makes me feel like it doesn't matter. And so it's also
which one do you use?
I can ask.
Well, I was
Oh, did you? What did she do?
Okay. It's this one. Yeah. So let me ask you about the so the it's this one. And she used like an iShares balance sheet. So
it goes.
so she's I got it.
How does it work?
The S.
Okay.
And then use the back sheet. And then she used, I think she was yeah, she was like one back sheet. So yeah. Did I answer your question?
Until.
I'm so sorry. Let me ask.
Because I have to do two, because I have one investment too, but it's basically the same thing. Yeah, I'm just gonna I'm good with busy life.
Good.
So up to this.
Busy Friday.
Hold on a second. Okay, you guys ready? Okay, quiet on the set. Kent, you gonna be okay?
I'll try.
Okay. Everybody pull out your phone, and if Kent faints, call 911. Okay. Okay, and action.
Hi, I'm Kent, this is Jeff, this is Evan. We have chapter 7, which is about the futures and options on foreign exchange. Here's the chapter outline. I'm not going to read it all, since you guys can all read. So the first topic is future contracts preliminaries. A futures contract is like a forward contract. It specifies that current currency will be exchanged on another day at a specified time in the future.
If you nudged it.
How it's different is every day it starts off with a new cycle. From a forward contract, it's different in the forward contract in that futures are standardized contracts that trades on organized exchanges with daily resettlements through a clearinghouse. The standardizing features are contract size, delivery month, and daily resettlement. Here is the currency future markets. There are a couple. The most common ones are the Chicago Mercantile Exchange, the CME group. And then the next most common one is the Singapore Exchange. There is a expiry cycle. It happens 4 times a year, March, June, September, and December. The delivery date is the 3rd Wednesday of every delivery month. And the last trading day is the 2nd business day preceding the delivery day. Here is a chart that shows all the exchange rates for each month, the high, lows, change, and then the open interest. So daily resettlement. With future contracts, we have daily resettlement of gains and losses rather than big settlement and maturity. This is what I mentioned before, it's a day-to-day thing, or as a big thing, it's a day-to-day. Every trading day, if the price goes down, the long pays the short, and vice versa, it goes up, the short pays the long. And then after the daily resettlement, each party has a new contract at the new price with a 1-day shorter maturity. An example of this is, say, considering a long position on the CME British Pound futures contract. It's written as 62,500 pounds, and the price is quoted in dollars and cents per pound, out to 4 decimal points. The minimum price increment is 0.0001 per British pound, which corresponds to $6.25 per contract. Go along with the futures contract at the price of $1.30 per pound. Initiation of contract, the long post an initial performance bond of $1,625, and the maintenance performance bond is $1,300. So as you track the performance bond, each day's loss are subtracted from the investor's account. If it's gain, it adds to it. If the investor loses more than $325, he has a decision to make. He can maintain his long position only by adding more funds, or if he fails to do so with his position, will be closed out with an offsetting short position. So this is just calculations of or example of the 3 days, calculations of the net gain loss per day and subtracting it. So the first day it sells at 1.3010, which is a gain, and then the next 2 days are losses getting greater and greater, and then it gets to the account balance of 1,300. So once it gets to that mark, you have a couple options. 3 options, or 3 ways of computing these gains and losses are either summing up the daily gains and losses, or taking the contract size times it by the initial contract price and the last settlement price, or you can take the ending balance on the account minus the beginning balance on the account, and it'll come out to the same number, the loss. Option contracts, calls in versus puts. Call options give the holder the right, but not the obligation to buy any given quantity of the asset at any time in the future at agreed upon price on that day. And then if you put options or just to sell, same thing, gives you an option to, you are not locked into that. Option contracts preliminaries, European versus American options. European options can only be exercised on the expiration date, while American options can be exercised at any time up and including the expiration date. American options are usually worth more than European options, other things equal, and then the moneyness aspect, if immediate exercise is profitable, an option is in the money, out of the money options can still have some value. And then these are just the currency option specifications and the contract size for each one.
This is just a basic call option profile, so you can just see basically the in the money and out the money. So whenever you're in the money, you're making money. Out of the money, you're not. Next one is just the same thing on a put. So when you're selling, you have the right to sell. You're in the money on the left side of the chart and out of the money on the right. So this is the market value, time value, and the value of an American call. You can see that like even the call has market value still in out of the money, even though it's technically not valuable. So we're going to consider two investments: buying a European call on the British pound on a futures contract, and the second option is to replicate the upside payoff by borrowing the present value of the dollar and then lending the present value at the strike price. So when the option is in the money, both strategies have the same payoff, but when it's out of the money, it has a higher payoff than the borrowing and lending strategy. So binomial option pricing. Binomial option pricing is an options valuation method, and it reduces the possibilities of price changes and removes the possibilities of arbitrage. Moving on to the hedge ratio, we replicate the payoffs. So you basically know what a hedge is with just reducing the risk, and this just is a way of calculating the ratio. So basically, if you take a hedge of 5,000 on a British hedge on a currency, you will hedge off 5,000 and then have a total of 10,000. And for example, that would be just a 1-to-2 ratio. And this is just the 3,000 over the 6,000, so 1-to-2 ratio. Currency future options are options contracts on a currency. For futures contracts that are exchange traded, futures contracts to buy or sell specified amounts of particular currency at a set price. If the futures position is not offset prior to its expiration, the foreign currency will change hands. And this is just an example of binomial futures options pricing.
Alright, so starting with the risk neutral valuation. A risk neutral valuation is the calculating of the hedge ratio. It is vitally important if you are going to use options. The seller needs to know the hedge ratio if he wants to protect his profits or eliminate his downside risk. It's just ratio, you're using the ratio, basically a conversion rate. The buyer needs to know the hedge ratio to decide how many options to buy. Knowing what the hedge ratio isn't especially important if you're only trying to value options. So it's mostly important with the size of whatever call you're making or put. Risk neutral valuation is a very handy shortcut to valuation. Okay, so these are just some of the conversion examples. using the forward prices to delivery at specific times. We can safely assume that IRP holds at a specific time that conversion rate from dollar to pound is 1.53 to 1. And then you just multiply that times, I think that the 1.07 is not specified, but that's got to be the time value of whatever it is. And you set the value equal to 100 pounds, 10,000 pounds, brought forward by the 1.53 conversion rate, and set that equal to the expected value of the two possibilities shown. And then the Q is the risk neutral probability. So solving for Q gives the risk neutral probability of an up move in the exchange rate. So here's just that math shown to you. This one explains the difference in certain time periods. So like if it was the difference between the end of the third and the fourth quarter, here it shows you that there would be a $0 payoff of right to buy 10,000 pounds for $15,000 at time in September, but $3,000 would pay off. You'd have a $3,000 payoff if you were to have done the same call in November, December. This slide just shows you the cycles for both the call and put options, and how they're basically the same. The value of a call option on 10,000 pounds with a strike price of $15,000 is $1,540 and some such change. And the value of a put at the same time is roughly the same. The option finish in the money, they have the same cash flows, so they should have the same value today. This is just kind of testing your skills again. It's the same as the last couple slides, using the risk neutral valuation to find value of a put. This again is the same, just more practice problems. You're setting the ratio up at the top of the screen, and then you're using different time values of the currency. You're just plugging them in and finding out whether or not what cash payoff you get. Just more practice. These guys got lucky and they got to give you the theory, and then all of mine are pretty much just the math. So if you guys want to go back and do this on your own time and like test your knowledge, like it says, it's all you.
Giving us homework?
Yeah.
Alright.
Get on it. Alright, things to be careful about. The conversion of future rates from one currency to another using forward exchange rates. Just because they're always fluctuating. Convert present values using spot exchange rates, discounting future values to present values using the correct interest rate, discount dollar amounts, and discounts amounts in euro. To find the risk neutral probability, set the forward price derived from the IRP equal to the expected value of the payoffs calculated using Q and solve for Q. And also you need to be careful about finding the option value discount, the expected value of the option payoffs calculated using the risk neutral probabilities at the correct risk-free rate. So yeah, just don't be dumb. Black-Scholes pricing formula. The Black-Scholes formula for the price of a European call and a put written on currency are given by this equation, which I struggled to define, but it's in the book somewhere. in summary, forward, futures, and option contracts are derived securities. Their value is derived from the value of the asset that underlies these securities. Forward and futures contracts are similar instruments, but there are differences. Both are contracts to buy or sell a certain quantity of the specific underlying asset at some specific price in the future. Futures contracts, however, are exchange traded, and there are standardized features that distinguish them from the tailor-made terms of forward contracts. The two main standardized features are contract size and maturity date. Futures contracts are marked to market on a daily basis at the new settlement price. A futures market requires speculators and hedgers to effectively operate. Hedgers attempt to avoid the risk of price change of the underlying asset, and speculators attempt to profit from anticipating the direction of future price changes. The CME Group and the NASDAQ OMX Futures Exchange are the two largest currency futures exchanges, and the pricing equation typically used to price currency futures is the IRP relationship, which is also used to price currency forward contracts. And finally, an option is the right but not the obligation to buy or sell the underlying asset for a stated price over a stated time period. Call options give the owner the right to buy, put options the right to sell. American options can be exercised at any time during their life. European options can only be exercised at maturity. Exchange traded options with standardized features are traded on two exchanges, and the options on spot foreign exchanges are traded at the NASDAQ, OMX, PHLX, and options on currency futures are traded at the CME. Thank you. Oh, you're gonna go? Yeah. Are the guys gone?
Yeah.
Where they at? Utah or something like that? concerning. We're not gonna go through the whole thing. Only gonna do 14 slides. So for the forward, So the forward market hedge for imports, if you owe foreign currency in the future, you can hedge by agreeing to buy the foreign currency by entering a long position in a forward contract, and that's just a relationship. In exports, you're going to receive foreign currency in the future, agree to sell in the future at a set price by entering a short position in a forward contract. Importers, forward market hedge, and US-based importer of shoes, order inventory payment is 100 million euros due in a year. The importer buys 100 million euros at a foreign exchange rate of $1.15 to the euro. The cash flows maturity looks like this. So, our firm is a UK-based exporter of bikes, sold 2.5 million euros to an Italian retailer, and the payment's due in 6 months. And our firm wants to hedge a receivable into pounds. This is the bid and ask price compared to the US equivalent of the pound and euro. Let me do that. Cool. Importer's money market hedge, same idea as covered interest arbitrage to hedge foreign currency payable by the present value and put in the bank at interest. So you buy the present value of foreign foreign currency payable today at the spot exchange rate, invested amount, and at maturity it will have grown to cover the payable. Okay, so same example, British Bikes owes £100,000 to an Italian supplier. The exchange rate is $1.50 to a pound. The 1-year interest rate is 4%, and the importer can hedge this payable by $96,153 or 153 pounds. Investing this at maturity, it will have 100,000 pounds at the interest rate, and the dollar cost today in US dollars $144,230.77. Importer's money market hedge will have redenominated a 1-year £100,000 payable into the same $144,000. And if the US interest rate is 3%, we could borrow that same today and owe $148,557.69 a year, and that's the formula. And this is just another example. It's a diagram of it, of all the exchanges. As you can see, the supplier is different. Exporter would be customer. Only difference in exporters is the exchanges to a customer, and the U.S. bank has a different interest rate than Italian. Another UK-based importer of bike example, you have 750,000 euros worth of bikes from an Italian firm. The payment is due in a year, and the firm wants to hedge the payable into pounds. The exchange rate is $2 a pound and $1.55 to the euro. Interest rates are 3%, 6% dollars, and 4% in pounds, and all quoted into APR. And the question is, how do you redenominate the payable with a 1-year maturity? So you sell pounds for dollars at spot exchange rate, buy euro, exchange rate with the dollars, invest at a 3% interest rate, and so that the future value of the investment equals 750,000 euros. And first step is borrow those pounds at a 4% interest rate, sell for dollars, buy euro with that 1.128 million dollars, and invest in the eurozone for a year at 3% APR. And the last step is repay your borrowing in pounds. And that's basically what it looks like. Yeah, that's all. That's all it is.
Is anyone a marketing major here, as well as a finance major? You are? Are you going to the marketing analytics event on Monday? Should go. There's two alums there, so they're actually running the whole event, and they're talking about it exactly. Mason, is that what you want to do? Marketing analytics?
That's my internship was this summer, but I'm like, not really doing it.
Sam, should ours?
Is that a nice class?
Even if you can just stop by for a little bit, it's from 4 to 5:30. You're a senior with a job. You can go.
Such a drama event before.
No one else marketing majors? As well as finance? No?